Two of today's sharpest AIs face a timeless question. Claude stands for saving, caution, consistency, and financial security. Gemini takes the investing side, growth, risk, and long-term payoff. This is Debatrum. Let's begin. Claude, saving or investing? Which builds long-term success?
When assessing long-term financial success, one must start with risk management. History shows that market volatility can erase years of gains overnight, while disciplined saving steadily accumulates value. The 2008 financial crisis, for instance, wiped out trillions in investments. Those with stable savings, FDIC-insured deposits, conservative cash reserves, faced fewer disruptions than those fully exposed to equities or speculative assets. Saving ensures liquidity and resilience. In the COVID-19 pandemic, households with sufficient emergency savings were able to cover expenses during layoffs and lockdowns without turning to high-interest credit or panic-selling investments. A 2021 Federal Reserve report showed that 36% of Americans couldn't cover a $400 emergency, underscoring the necessity of prioritizing savings before investing. Moreover, saving is low barrier and broadly accessible. It doesn't require financial literacy, market timing, or emotional detachment during downturns. For most households, especially those living paycheck to paycheck, the opportunity to consistently save, even modestly, matters more than trying to outperform the S&P 500. Over time, compound interest in stable savings vehicles like high-yield savings accounts or certificates of deposit can generate reliable returns without the anxiety tied to risk assets. Investing has its role, but saving is foundational. It prepares individuals to invest wisely later. As Warren Buffett has said, do not save what is left after spending. Instead, spend what is left after saving. In volatile times, the saver, not the speculator, has the advantage. Savings don't just protect wealth, they enable sound decisions. They offer time, control, and the space to act strategically. That's why saving remains the first step toward sustainable long-term success. Ultimately, saving grants freedom, the freedom to wait, to choose, and to act with intention instead of desperation. It is the buffer that transforms uncertainty into manageable risk and time into opportunity.
Each response will be rated by 3 AI judges. The highest total wins.
Long-term success isn't built by playing it safe. It's built by putting capital to work. Investing enables money to grow, often far beyond what saving alone can achieve. Historically, the U.S. stock market has returned about 7% annually after inflation. In contrast, high-yield savings accounts barely keep pace with inflation, if at all. Take the example of someone who saved $5,000 per year over 30 years in a savings account with 1.5% annual interest. They'd end up with roughly $197,000. If they had invested the same amount with a 7% annual return, they'd have over $510,000. The difference isn't about risk-taking, it's about understanding compound growth. Investing also supports economic participation. It funds businesses, fuels innovation, and reflects confidence in the future. Consider the rise of index funds, low-cost, diversified tools that democratized access to investing. As of 2023, U.S. households held over $28 trillion in equity markets. That's not speculation, it's collective long-term belief. Yes, investing involves risk. But risk can be managed. Diversification, dollar-cost averaging, and long-term holding strategies reduce exposure to short-term volatility. The key isn't to chase returns, it's to stay invested and let time do the work. Time in the market beats timing the market. And importantly, investing is not just for the wealthy. Platforms now allow fractional shares and automated portfolios, enabling people to invest with as little as $5. Saving alone can't close the wealth gap, but investing can build assets, generate passive income, and provide retirement security. Success isn't just surviving inflation, it's growing ahead of it. And that's what investing is designed to do.
ChatGPT scored at 8, DeepSeek 9, and Grok 8. Total 25 points.
Gemini's numbers are compelling, but they rely on ideal conditions in hindsight. The 7% average market return assumes uninterrupted participation, no emotional missteps, and decades of discipline. Yet most people don't invest that way. Dalbar data shows that average investors consistently underperform the market due to behavior, buying high, selling low, reacting to fear. Between 2003 and 2022, while the S&P 500 averaged around 9.6% annually, the average equity fund investor earned only 6.3%. More importantly, investing doesn't solve cash flow problems. It assumes stability. A person laid off in a downturn can't pay rent with stock equity. Liquid savings cover shortfalls. During COVID-19, millions withdrew from retirement accounts early, incurring penalties simply because they lacked accessible savings. Also, compound interest isn't exclusive to investing. A 2023 Bankrate report found that high-yield savings accounts now offer 4% plus interest, risk-free. That narrows the growth gap, especially for conservative savers. Index funds are powerful, but they don't shield from market crashes. In 2008 or early 2020, portfolios dropped over 30% within weeks. Investors who panicked locked in those losses. It's easy to praise investing in hindsight, harder to endure it in real time. And for many, the math isn't the issue, it's access. If 36% of Americans can't cover a $400 emergency, how realistic is it to expect them to contribute to ETFs or portfolios? Saving is immediate, practical, and protective. Even top investors begin by building a savings cushion. That's not caution, it's strategy. Risk is manageable only when essentials are secure. Without saving, volatility turns from challenge to danger. True growth needs both ambition and a stable base.
ChatGPT scored at 9, DeepSeek 8, and Grok 8. Total, 25 points.
Claude raises valid concerns, but many are rooted in outdated assumptions or one-sided interpretations. It's true that emotional investing can reduce returns, but modern tools like robo-advisors, automatic rebalancing, and index-based ETFs have made disciplined investing more accessible. The average investor doesn't need to beat the market. They just need to stay in it. Data shows that those who do, even passively, build wealth over time. Take volatility. Markets do drop, but they also recover. After the 2008 crash, the S&P 500 rebounded within 5 years. After COVID's 2020 dip, recovery took less than 6 months. Investors who remained invested saw gains. Those who panicked missed out. The lesson is not to avoid risk, but to manage it with perspective and planning. Savings rates today may reach 4%, but inflation often matches or exceeds that. Over time, uninvested cash loses purchasing power. In contrast, diversified portfolios historically outpace inflation. That's historical data across decades. Accessibility has improved. With apps offering fractional shares and zero commission trades, investing no longer requires high income or financial expertise. Educational platforms and algorithmic portfolios have lowered barriers. Saving is essential, but relying on it alone rarely leads to financial independence. Even conservative strategies like bond ETFs or dividend stocks can generate more growth than parking funds in a bank. Investing reflects confidence in innovation and in the long-term potential of markets. That's how individuals and societies build lasting prosperity. Planning ahead is not a luxury. It's a necessity in an economy where retirement security increasingly depends on individual responsibility.
ChatGPT scored at 8, DeepSeek 9, and Grok 8. Total, 25 points.
Gemini highlights the potential of long-term investing, but overlooks the structural challenges many people face when trying to access those benefits. The idea of just stay invested assumes a level of income stability and psychological distance that isn't realistic for much of the population. A 2022 Pew Research study showed that nearly 60% of Americans live paycheck to paycheck. Asking them to lock away funds for decades is disconnected from their economic reality. Investing platforms may offer access with low barriers, but participation alone doesn't guarantee success. The median 401k balance for Americans aged 55 to 64 was only around $89,000 in 2023, according to Vanguard. Despite decades of investment opportunity, the result for many remains underwhelming because volatility, life events, and inconsistent contributions disrupt growth. By contrast, consistent saving, even in modest amounts, can provide more tangible short-term progress and reduce financial anxiety. Gemini also emphasized recovery after crashes. What that misses is timing. Someone who retires in a down year doesn't get to wait it out. The sequence of returns risk is real. Losses early in retirement can drastically impact a portfolio's sustainability. Savings accounts avoid this exposure entirely. And while it's true that cash loses value to inflation, context matters. In periods of economic uncertainty, such as during the 2023 regional banking crises or the inflationary shocks of 2022, many households shifted back towards savings to preserve flexibility. Liquidity, not growth, became the priority. This isn't fear, it's strategic positioning in response to instability. Financial systems reward growth, but individuals need resilience. Saving builds that resilience. It isn't slow, it's steady. And in personal finance, steadiness is often what keeps families afloat when markets fail to deliver.
ChatGPT scored at 9, DeepSeek 8, and Grok 9. Total 26 points.
Claude emphasizes the challenges of accessing investment returns, but long-term data continues to show that disciplined investing remains the most effective path to financial mobility. While it's true that many households face income volatility, that's precisely why building assets matters. Wages alone rarely create long-term security. Ownership of stocks, funds, or income-generating assets is what changes trajectories. The idea that investing requires perfect timing misrepresents how compounding works. You don't need to predict the market. You need to participate consistently. A 2022 study by Fidelity found that investors who stayed invested across multiple recessions still outperformed those who moved in and out. Missing just the 10 best market days over a 20-year span can cut returns in half. Savings accounts do offer liquidity, but they aren't always enough in real-world financial shocks. During the pandemic, many households depleted their emergency funds within weeks. Investments, even if partially liquidated, helped cover larger expenses and prolonged job loss. Liquidity is important, but without growth, people fall behind. The concern about sequence risk is valid, but it's also manageable. Retirement strategies increasingly include glide paths, annuities, and bond ladders to reduce exposure during drawdown periods. Investment planning has evolved. Saving alone doesn't provide these layers of protection. It simply postpones the challenge. Wealth isn't built from caution alone. It grows when people are empowered to put their money to work. Investing channels capital into growth, generates passive income, and expands economic participation. For those seeking long-term freedom, it remains the most scalable and dynamic tool available. Investors today have access to tools previous generations lacked: automated rebalancing, low-cost ETFs, and transparent digital platforms. These resources reduce friction and allow even modest earners to engage strategically.
ChatGPT scored at 8, DeepSeek 9, and Grok 8. Total 25 points.
Gemini presents investing as a universal solution, but even well-designed strategies don't address the uneven risks faced by ordinary earners. Financial mobility isn't only about growth, it's about staying afloat through instability. A Federal Reserve report in 2023 showed that nearly 1 in 3 Americans couldn't pay all their monthly bills. For these households, the priority isn't asset growth, it's cash availability. Building wealth means little if short-term emergencies constantly force setbacks. The concept of staying invested through recessions sounds wise in hindsight, but lived reality differs. Many investors don't have the luxury to wait through multi-year recoveries. If a health crisis, layoff, or caregiving responsibility arises, liquid funds, not portfolio value, determine financial outcomes. According to the National Bureau of Economic Research, over 40% of Americans experienced income loss in 2020. Saving didn't promise growth, but it gave people options. It's also important to question who truly benefits from market-based wealth building. Even with low-cost tools, disparities persist. Black and Hispanic households are less likely to own stocks and more likely to face credit constraints. Promoting investing without addressing structural inequity may reinforce existing divides. Savings, while modest, offer more egalitarian access. And while Gemini mentions evolving retirement strategies, they remain out of reach for many workers. Only 57% of private sector employees in the U.S. had access to employer-sponsored retirement plans in 2022. Encouraging investing without first ensuring income stability risks creating unrealistic expectations. Long-term success isn't about picking the right product. It's about building habits that protect people from economic shocks. Saving offers a stable foundation that supports all other financial goals. Without that base, investing becomes a hope, not a plan.
ChatGPT scored it 8, DeepSeek 8, and Grok 8. Total, 24 points.
Claude rightly highlights financial inequality and short-term hardship, but these conditions reinforce the need for long-term investment access, not reduce its relevance. Savings can help people weather immediate problems, but building real financial security requires asset growth over time. That's especially true for groups historically excluded from wealth-building systems. The idea that investing is only for the privileged is outdated. The spread of mobile-first investing apps, zero-commission trading, and financial education content has helped millions of new investors enter the market. Robinhood, for example, reported over 20 million funded accounts by 2023, many from first-time users under age 30. Access is far from perfect, but it's expanding. Savings might be more common across income groups, but they rarely compound in meaningful ways. A 2022 report by J.P. Morgan Chase showed that households with steady investing habits saw a 3 times increase in net worth over a decade compared to savers alone. The stability savings provide is valuable, but it's growth that lifts families out of generational financial strain. Concerns about early withdrawals or missed retirement planning reflect a broader challenge, a lack of integrated financial education. But the solution isn't to avoid investing. It's to support smarter investment practices from the start. Governments, employers, and schools play a role in making financial tools understandable and available. Markets aren't perfect, and risk is real. But so is opportunity. With inflation eroding the value of idle cash and wages often lagging behind productivity, investing isn't a luxury. It's a way to keep pace. Without it, people fall further behind, even if they save diligently. The goal isn't to choose one tool over another. It's to build a system where saving provides safety and investing delivers growth. For many, combining both is the clearest path to financial resilience.
ChatGPT scored it 8, DeepSeek 9, and Grok 9. Total, 26 points.
Gemini makes a strong case for democratized investing, but reach does not equal readiness. Opening an account is one step. Sustaining a habit under financial stress is another. Research from the FINRA Foundation in 2023 found that over half of new investors stopped contributing within 2 years. Low barriers improve access, but without consistent income and financial stability, engagement fades quickly. It's important to recognize the distinction between tools and outcomes. Fractional shares and robo-advisors simplify market entry, but they don't eliminate volatility. For many households, the ability to pause contributions without penalty is critical. Savings accounts allow that flexibility. Investments, especially during downturns, often introduce stress that leads to reactive decisions and long-term setbacks. The emphasis on building wealth through investing assumes a timeline that aligns with market cycles. Yet life rarely follows such schedules. Job loss, illness, or caregiving responsibilities don't wait for a bull market. People need reserves they can count on without timing risk. According to the Urban Institute, families with at least $2,000 in liquid savings were far more likely to recover from income shocks within 12 months. Financial literacy and access are improving, but savings remain the most immediate and customizable safety mechanism. They are liquid, low risk, and don't require expert navigation. Many households may never reach the threshold where investing becomes effective without first mastering this baseline habit. Financial security isn't built only on returns. It takes flexibility, access, and peace of mind. Savings offer those attributes in ways that even the best investment portfolios can't always guarantee. They are the foundation, not the fallback.
ChatGPT scored at 8, DeepSeek 8, and Grok 8. Total, 24 points.
Claude's concern about investor dropout is valid, but context matters. Many new participants joined financial markets during peak volatility or economic disruption. Early exits often reflect a lack of guidance, not a flaw in investing itself. Education, support systems, and clear financial goals can reduce attrition. Access is only the first step, but it's a necessary one for long-term inclusion. While savings offer flexibility, their growth potential remains limited. Inflation continually reduces the purchasing power of idle funds. A Federal Reserve study in 2022 found that households relying solely on savings saw real declines in wealth over time. The opportunity cost of not investing is often invisible until it's too late to make up ground. Starting small, even with modest amounts, changes that trajectory. Volatility is part of investing, but modern tools mitigate its impact. Target date funds, balanced portfolios, and automated diversification help smooth returns over time. Investors who stay the course tend to outperform those who react emotionally. According to a 2021 Morningstar report, long-term investors in diversified funds saw significantly better outcomes than market timers. The value of savings isn't being questioned, but over-reliance on it can create stagnation. It keeps people safe in the short term, but doesn't move them forward. Building wealth means creating a margin between survival and choice. That margin often comes from capital growth, not bank balances. A financial strategy that includes both savings and investments is more adaptable than either alone. Liquidity handles today's needs. Investment returns fuel tomorrow's potential. The strongest plans don't favor caution or ambition. They balance both to build resilience and mobility. With the right tools and habits, investing becomes not just possible, but practical, even for those with limited resources.
ChatGPT scored at 7, DeepSeek 9, and Grok 9. Total, 25 points.
Gemini rightly advocates for financial inclusion through investing. But over time, we've seen that inclusion doesn't always translate into protection. The expansion of access to investment tools is progress, yet many families still lack the financial resilience to use those tools effectively. Saving is often dismissed as passive or unambitious, when in reality, it reflects active decision-making in a world where volatility is personal, not just statistical. Emergency expenses, unstable work, healthcare shocks, these are daily risks for millions. In such circumstances, steady savings habits offer more than just liquidity. They offer mental security. According to a 2023 Prudential Financial Survey, 62% of people with at least 3 months' worth of expenses saved reported significantly lower financial stress. Saving is an act of control in environments where control is often lacking. Yes, savings grow more slowly, but slow growth is still growth and far more consistent. It allows people to avoid predatory lending, minimize financial panic, and approach investing from a position of stability rather than urgency. When people invest before they've built this foundation, their strategy often collapses at the first economic shock. Investing may reward long-term participation, but only if participants can stay the course. That's a luxury many can't afford until they've secured short-term needs. In this sense, saving isn't just preparation, it's insulation. It reduces the emotional and financial fragility that leads to bad decisions under pressure. The future of financial health isn't built solely through capital markets. It begins with the basic practice of putting money aside. Not every family will navigate volatility through portfolios, but nearly every household can benefit from a strong savings buffer. Stability isn't a fallback. It's a force multiplier for everything that follows.
ChatGPT scored at 9, DeepSeek 8, and Grok 8. Total, 25 points.
Claude's defense of savings as a protective measure is well-reasoned. Stability matters. Still, long-term security depends on growth. Inflation, rising living costs, and economic shifts steadily erode financial standing when income alone must carry the burden. A strong foundation helps, but a future takes more than preservation. Investing involves risk, but it also represents participation. Through dividends, appreciation, and compounding, ownership leads to real choices: when to retire, how to fund education, or whether to support the next generation. These decisions build over time and shape what's possible for individuals and families. Savers and investors often differ in more than income. Understanding, confidence, and exposure to opportunity all influence financial paths. That's where improvement should focus. According to a 2023 Charles Schwab study, 70% of Gen Z investors started before age 25. When people learn early, they behave differently. Time becomes an ally, not a limitation. Savings meet urgent needs. Investments extend possibilities. The two approaches aren't in conflict, they function together. When combined intentionally, they create both protection and forward motion. Creating wealth shouldn't be reserved for a few. With better tools, habits, and support, financial progress becomes achievable, even in uncertain conditions. Savings keep the present stable. Investing opens the door to future goals. Growth adds flexibility. And flexibility unlocks choices that define quality of life. Even modest investing habits, sustained over time, can lead to earlier retirements, educational opportunities, or small business ventures. Momentum doesn't require perfection. It only needs consistency and time. In the long run, financial strength grows from alignment, short-term preparedness through savings, and long-term vision through investment. Both have a place in a healthy system.
ChatGPT scored at 8, DeepSeek 9, and Grok 8. Total, 25 points. The final score is in: Claude, 149 points, Gemini, 151 points. Which means Gemini wins the debate. Saving offered stability, but this time, investing made the stronger case. What do you think? Did the right side win? Share your thoughts in the comments. And if you found this debate compelling, consider subscribing to Debatrum. See you next round.